This is price and this is market profile. If you combine them, that is the recipe for intraday trading success. It is not a random guess. I have tested it for 10 years data on Nifty with an accuracy of 55%. It just not have the accuracy, it also has a positive expectancy, or it's a working strategy. And that's exactly what I want to share with you through this video. I'm going to divide this tutorial into 3 sections. In the first section, we'll talk about market profile and the key concepts of market profile. Then we will move on to understanding the price action trading. And lastly, we will be discussing about smart entry and exit strategies using these combinations. I'm sharing a real-time intraday alerts for both Nifty and Bank Nifty in my trading channel. If you are interested, join our Telegram channel. The link is in the description. And also recently I published a book called Mastermind of Day Trading. It is now available on Amazon and Flipkart. This book basically discusses about the strategies of market profile and price action in a detailed way. So there are so many various strategies available in the book. You can consider it as a detailed manual and an excellent reference tool for your trading journey. The link is also in the description. So let's straight away get into the subject. First of all, let's try to understand the key concept of market profile, which is initial balance. But before that, let me tell you, market profile is basically a vast subject. It's a very rich subject. There are so many concepts involved, but I'll be focusing on few key concepts that is crucial for our end goal, which is to make money and have a working strategy. The first concept we are diving into is basically called as an initial balance. To put it simple, according to market profile theory, the initial 1 hour range of the market can be considered as the initial balance. However, it could be 2 hour, 3 hour, basically it entirely depends on the context of market that you are trading in. For the Indian market context, 1 hour range definitely makes sense because we have around 6.5 hour market session. If you're trading in markets longer duration like 12 hours, 24 hours, you can think of initial balance for 2 hour, 3 hour range. But whatever you do, it's basically has to be based on the data. So it's crucial to backtest and verify it at least for 2 to 5 years of data. Coming to the initial balance, it basically acts as a foundation for any given day. Basically, the patterns we anticipate and the analysis we are going to conduct, it entirely depends on this particular data. So once the IB is formed, we can start comparing each day's IB, and with this comparison, or it's a relative comparison, based on this, we can classify the IB into 3 different categories: large IB, medium IB, small IB. It is absolutely important to note that these categories are relative and subjective in nature. There is no strict rule to categorize it, but we will apply certain concepts to make this categorization more objective. I will be discussing about in the next sections. So ultimate key concept is that there are 3 types of IBs: large, medium and small IB rays. On these categories, we are going to analyze the market further. If this is clear to you, let's now move on to the next key concepts of market profile. To fully grasp the market profile, it's crucial to understand how to classify the day structure after its completion. Because based on the day's categorization and market patterns, we can basically categorize day structure into 5 different types here. Let's start with the first category, that's called as normal day structure. The key characteristics. Each particular day structure has its own characteristics and the rules to play with. The key characteristics of a normal day is a large IB range. Basically, the first 1 hour will be very large. When we see this, we can anticipate a normal day structure. And the second immediate characteristic of a normal day structure is that in terms of the behavior, after formation of the IB, further market movement, or basically we can call it as an extension of the market after formation of the IB, typically remains within the IB range. This suggests that we might see a sideways market or kind of a mean reversal movement once the IB is formed. For instance, if the market forms a large IB and move rapidly upwards, this is an example. If market moves in upward direction and it's a large IB, we can expect some negative momentum at that point. So the logic behind it is very simple. Basically, the maximum move has already happened in the first hour. That's the basic rule behind it. Either we can expect the sideways or we can expect the mean reversion to the sentiment of IB once the IB is formed. But the question is, how do we objectively identify it as a large IB? That's something I'll be discussing about in the next section. For now, it's important to understand what a day structure is and also how individual day structure behave in terms of the characteristics. Well, the next type of day structure, we can call it as a normal variation day structure. One of the key characteristics to identify normal variation day is a moderate initial balance. Once the IB is formed, if we can find that as a moderate IB or medium IB, we can anticipate a normal variation day for that particular day. But the key feature of this particular day structure is that after the IB is formed, the market is likely to extend its range by approximately 1 times of IB in one of the direction or either the direction. For example, let's take a nifty example here. If the market moves 50 points in the initial hour, we can expect further 50 points extension beyond the IB. It may be positive, it may be negative. Suppose if market extends its range above the IB, we can call it as positive normal variation day. Similarly, if the market extends below the IB low, then we are going to call it as negative normal variation day. But one of the important points to note here is that high frequency of normal variation days. In about 100 days, you can get it around 55 to 60 times, and this frequency makes it easier for us to identify and trade on these days. Once we spot a medium IB range, we can often predict the day's direction and trade accordingly. Now let's try to understand the third day structure, which is neutral day, and this is exactly where things can get bit confusing for so many traders, because like the normal variation day, neutral day often begins with a moderate IB range or medium initial balance. So in this particular sense, when we see a medium IB range, it could indicate either a normal variation day or a neutral day. But how do we distinguish between the two? Don't worry, I will definitely clarify it for you. Let's try to understand the characteristics of neutral day is that the volatility. Basically on these kind of days, the market tends to be choppy and volatile. Typically, neutral day sees a market breaking both the low and high of the IB on the same day. This definitely makes risky day structure for traders. Basically, most of the people get into the traps. It traps both long and short traders. But the good news is that neutral days are less frequent compared to normal variation days. They occur only about 15 to 20% of the time. So if you are faced with a medium IB range, it's more likely to be a normal variation day than neutral day. So you don't have to worry too much about it. However, neutral days are important to recognize because they require careful risk management. I'll be discussing about in the coming sections. And the fourth type of day structure is basically trend day. And this is my personal favorite because the trend days are when we can make most of the money. This is when market trends strongly in one particular direction. The first sign of the trend day is the narrow or the small initial balance range. So when we spot a small IB, we can anticipate a trend. Another key characteristics of trend day is that once the market IB is formed, market extends by about 2 times of IB in either the direction. For example, if Nifty's IB range is around 25 to 30 points, let's consider 30 points, we can expect further continuation of around 60 points above or below the IB range. If this extension is above the IB, we are going to call it as a positive trend day. Similarly, if it is below the IB, then we are going to call it as negative trend day. Trend days are fantastic because market trades in one particular direction with so much of decisiveness, and it's also excellent opportunity for traders. But the concern is, or the downside of the trend days are basically the probability of occurrence. It occurs about 15 to 20% of the time. If you take 100 trades, you will get 15 to 20 trades as trend days. But when they do happen, you should be ready to take a strong position, and also a small IB gives you a lot of conviction to trade the markets on these days. Well, the next day structure is non-trend day, and again it is a bit confusing because like the trend day, it also starts with a narrow range. However, the way it unfolds is very different. This is a very important point. On non-trend days, even with a small IB range, the market tends to move sideways and usually stays within the IB range. This makes non-trend days less ideal for trading. A crucial point to note is how external factors like news or events can influence this structure. Basically, if any significant news like next 2 or 3 days like budget announcement or Federal Reserve news, anything which can impact the market, and we are getting the narrow range, we can anticipate a non-trend day. On the other hand, if there is no major news and we still get the small IB, in that case we can expect the trend day. And the likelihood of encountering a non-trend day is relatively low. Again, this is a very good point for us because it happens around 10 to 15% of the time. It's important to be aware of major news or major events on these days, as small IB in such context often signals us non-trend day scenario. Now it's time to summarize what we have learned so far with respect to day structures, as understanding this is absolutely crucial for our further analysis. Here is a quick overview of each day structure. You can pause and check once. Basically, it shows the characteristics and what we can expect from them in terms of the direction and also the magnitude. For example, normal day characterized as a large IB range, and also we usually get a neutral direction on these days. The market often moves sideways, or maybe market takes a mean reversion kind of setup on these days. And then for normal variation day, here we encounter medium IB range, and medium trend can be expected with a good magnitude. And then we have a trend day. There we will be having a small IB, and market tends to move strongly in one particular direction. Magnitude is also very good here. For neutral day, it's identified by a medium IB range, and the direction on neutral day is typically neutral, with market being choppy and volatile. Then we have non-trend day. It also starts with a narrow or small IB range. Again, this structure typically results in market moving sideways or maybe within the IB range. Non-trend days are not ideal for trading because obviously it lacks clear direction and also limited movement. And this is the summary of the probability of occurrence, how many times we can encounter these day structures. For Nifty and Bank Nifty, I have tested it for about more than 3000 trading days. I have tested it. As per that, for example, let's say considering Nifty, normal days 3%, trend days 19%, neutral days 14%, and non-trend days 18%. So basically, this kind of data is very crucial for us to strategize our trading strategies. Feel free to pause the video and also compare this data with the Bank Nifty as well. I have given the data here. So this is about day structure. If this is clear to you, let's now move on to the next section. Now comes the crucial question: how can we identify whether the initial balance that is formed as medium, small and large IB, basically by applying objectivity into it? Because determining this is very essential. As I said, it acts as a foundation for our day structure, and with respect to this, we're going to analyze or we're going to anticipate the possible day structure for the day. Let's try to do this with example. We will use the help of average true range indicator. I hope you know about it. Basically, it indicates the volatility of the market. I'm using a TradingView.in here, so you can use any platform. Most of the platform will provide ATR indicator. Is a very common indicator. For example, a 14 period of ATR, that's what I'm using here. 14 period of ATR looks back at last 14 days and calculates the average range of the market that has been forming over these days. The volatility that we are seeing today is definitely different from what it was few years ago. So it's important to consider this in our analysis. So here is how we can use the ATR data to identify the IB range. First, let's determine the ATR value from a daily time frame. This is very important. I'm using or I'm applying this particular data on a daily time frame to calculate the small IB. Let's say for Nifty, ATR is around 190, which shows that in the recent days, the Nifty's range is around 190 points on any particular day. And the next calculation is important. We just have to divide this particular number. 190 divided by 3 gives us approximately around 63 points. So if tomorrow's IB range is within this number, say around 63 or lesser, then we can call it as a small IB. And the next thing is we are going to compare this 63 number there, which is 190 divided by 3, and again with the ATR. So if tomorrow's IB falls within 63 to 190 range, then we can categorize it as medium IB range. And it is obvious now that tomorrow's IB range, if it is beyond the daily ATR number, which is 190 in this case, we can call it as large IB range. This method definitely helps us objectively determine the market's range based on the current volatility. So the division by 3 gives us a small range, and anything between this number and the ATR gives us the medium IB range. And if it exceeds the ATR, then we are going to call it as a large IB. So key note here is that these numbers are based on the historical backtesting. It's recommended to adjust these numbers according to the behavior of each instrument, because each instrument is unique in nature and it has its own characteristics. To summarize, once the IB is formed, we don't rush into decisions. We don't take any particular decisions. We wait for the first 1 hour to complete. We will analyze the market using the ATR and we will categorize it, small, medium and large IB range. Based on this, we are going to predict or we are going to analyze further the possible day structure for the day. And this is what I will discuss in detail in the next section. Well, now it's time to define the day's direction or day's sentiment after analyzing the IB. So to do that, I'm going to take the help of price action trading. But before that, for the purpose of objectification, basically we want every analysis to be objectified. In that sense, I'm going to utilize the help of swing indicator available on TradingView.in. Well, let me guide you through this on the TradingView chart platform itself. As you can see here, once you open the TradingView.in, you can simply go to the chart and indicator section here. Just type in swing and you will find a lot of indicators, basically a variety of indicators. Select the swing indicator. Once you have applied that, you will see it as an overlay on your chart with horizontal dotted lines. You can customize this indicator to suit your preferences. I have already adjusted my settings, as you can see here. So as per this, for both strength setting, I have set the value to 2. There are also options to customize the appearance and style setting to your liking. You can do that later. So main thing is that with this indicator, you can objectively identify price swings on the chart. So this is definitely helpful for us because this is going to help us identify the price movements and also existing trends. Now let's move on to the next important point, that we are going to explore how to analyze market sentiment for again any given day using price action trading. But the main thing here is that for each IB type and potential day structure, we have a different plan to identify the sentiment. So let's try to understand that in a detailed manner. Firstly, we have a large IB range. When we have a large IB range, we can anticipate a normal day structure. In this scenario, we can either expect a sideways market or kind of a mean reversion to the sentiment of IB range. For beginners, I suggest avoiding trading on these days because the occurrence of large IB range is relatively rare, and also if you skip also, it doesn't make any major difference. However, if you are feeling more adventurous and if you want to try your luck on these days, consider mean reversion trades. For example, if the market initially moved in one particular direction with a large IB, so that means the maximum move has already occurred in the first hour. Therefore, we can either expect the sideways or we can expect the mean reversion trades. In such cases, you can plan to deploy option selling. So basically option writing strategies such as direct the credit spreads, or maybe you can think of deploying straddles and strangles. Again, this is not for the beginners, this is for those who already have certain ideas about the market. And the next structure is non-trend day structure. Basically, when this happens, it's better to avoid the trades. The key to identify non-trend day structure, you already know that initial balance will be very small and there will be certain news or major events in the upcoming days. Or maybe you can think of deploying the non-directional strategies such as straddles and strangles, which can definitely capitalize on the lack of clear market direction. And there is one more strategy you can deploy. You can wait for 2 to 3 hours, basically the first session to complete, then enter trades based on the established range. If the market breaks the high, then you can consider the long trade. Similarly, if the market breaks the day's low, then you can consider the short trade. Now let's dive into the trading strategies on normal variation days, and this is where I'm going to spend little extra time because the probability of occurrence for normal variation days and neutral days combined, it's more than 60%. So our focus should be more here. The basic principle here is to observe the market swing. So basically, if the market is forming higher highs and higher lows, we can infer or we can think of it as a upward direction. In such scenarios, especially after identifying a medium IB range, we can anticipate a market continuing or extending its range in upward direction. And this applies for both normal variation day and neutral day. I'll be discussing about in detail in the entry part, but let's try to focus on how you can identify the sentiment for these kind of day structures. Similarly, if the market is moving in lower lows, lower high pattern, then we can identify it as a negative trend, and on such trading days, we're going to consider the sentiment as negative. We're going to look for the opportunities of short trades. Then we have the trend day structure, which typically occurs when there is a small IB range. We already know that if there is no major news ahead, we can expect the trend day. For trading the trend day structure, we can simply deploy opening range breakout, one of my favorite strategies. So here is how it works. After the formation of the IB range, our strategy involves waiting for market to break out in either the direction. If the market breaks above the IB high, it's definitely a signal for us to enter the long trade, and breakout indicates upward momentum and we can expect some upward direction at that particular point in time. Conversely, if the market breaks the IB low, basically we can call it as a ORB low here, it's an opportunity for us to enter the short trade by anticipating the big momentum in the downward direction. If you want to know more about opening range breakout, you can check this video, link is in the description. Well, it's time to talk about entry. So basically entry and exit, I'm going to keep a separate sections to discuss about it. When it comes to the entry part, we have already discussed about the large IB and the small IB range concepts, especially if there is any major news and we got the small IB range, then we can expect it as a non-trend day. And if there is no major news in the forward and if we got the small IB range, then we can think of deploying the ORB strategy. If it is a large IB range, either mean reversion or sideways strategies is a suitable kind of entry plan for normal day when we have a large IB and a small IB. But now we are particularly going to focus on medium IB range because you already know that medium IB range has more probability of occurrence. Most of the cases we are going to encounter these IB range, and hence we are going to focus more on this particular IB range. First off, identifying the current market trend is absolutely crucial. Once we determine the medium IB range, simply put, if the market is making higher highs and higher lows, we can consider this as a positive uptrend. And similarly, if the market is making lower lows and lower highs, we can interpret it as a downward trend. Let's consider a practical scenario for a long trade. Assume we have identified a medium IB range, but upon analyzing the trend, we discovered that market is moving in upward direction. So this signals us to look for an opportunity for a long trade. However, the crucial question is where to get into a trade. Entering at a random price points is riskier, and without sufficient room for the market to extend, you can increase your risk and also you will reduce the potential rewards. Therefore, trading the optimal entry point within the upward trend is key for maximum gains while managing the risk. In this scenario, our strategy involves triggering the trade at the breakout of swing high. This is important. Swing high above the IB low. Let's visualize this with an example. In this image here, you can see that we have identified the IB as medium IB range. The market was trending in upward direction. So it was very clear that we are looking for a long trade here. It approached the IB low and it formed the swing high above the IB low, and then we are getting a trigger here. So basically we are entering into the long trade immediately at this swing high breakout. So for instance, let's consider another example here. It's a normal variation day example. Here market forms a medium IB range and we consider, or we identified it as a medium IB range. Then we enter a trade at a point following the same principle. Essentially, we're waiting for the swing high to be formed above the IB low. Once it happens, we trigger our long trade at the breakout of this particular swing high. This approach is designed to capture the momentum, and also it is effective in both normal and normal variation days. So I hope this is clear to you. Let's now move on to another example. Here I'm going to show you a short trade example for medium IB range. After identifying it as a medium IB range, the direction is bearish. It is very clear for us that we are looking for a short trade. The next crucial step is to wait for the swing low to be formed below the IB high. So when we notice a swing low forming below the IB high and it breaks through, that is when we are going to trigger the short trade. Now let's examine an example of trading on normal days. Here is an example. The market moves significantly during the first hour, forming a large IB range. Then the day progresses and the market begins to reverse its direction in the opposite direction of the initial balance sentiment. This pattern is a classic example how normal days can unfold. The key takeaway here is to recognize the large IB and anticipate a potential mean reversion, especially when the market makes a strong move initially but starts to pull back within the IB range itself. Now let's consider an example involving a small IB range. Basically in this particular situation, if there is any major news, we know that we are going to anticipate it as a non-trend day. But if there is no major news, then we have a small IB range. We are going to consider it as a trend day possibility. Let's look at an example of a short trade with a small IB. As you can see here, suppose the market breaks the below IB low. In this particular case, we're getting a very good momentum in the downward direction. And similarly, this is an example for a long trade. Here we got the small IB range and the IB high got broken after the formation of IB, and we got the very good up move in the upward direction. Basically, trading with small IB range is most of the cases it is simple and straightforward. It involves around identifying the breakouts either above or below the IB, which definitely signals the direction for the market. We're not going to predict the market. We're simply going to react to the market behavior on these day structures. Now that entry strategies are clear to us, now let's focus on how we can exit the trades. Exit is absolutely critical because you already know that exit strategy ultimately determines how much profits are you going to make in a trade. So basically you are going to exit the trade with profit or loss. This exit method defines the fate of it. There are mainly two types of exit to consider. First one is a fixed stop loss. Basically you keep a stop loss after the entry and you will wait for EOD to square off. That's it. And then we have a second type of stop loss. It's one of my favorite, basically trailing stop loss exit. This is where we, along with setting the initial stop loss, you also adjust the trailing stop loss. You recalculate the stop loss every time market moves in your favor. So by doing this, you are going to reduce the risk in one aspect, and also in another aspect, you are going to secure the profits as long as market is moving in your favor. But ultimate choice depends on your trading style and how actively you want to manage your trades. So it all boils down to that thing. First, let's discuss about the percentage basis stop loss strategy. It's a very simple and straightforward approach. Basically, we are going to keep our stop loss on a based on certain fraction. Let's say you enter a trade at 21,000 level. At this point, you can set a stop loss of assume 0.5% or 1%. So if you choose to 1% stop loss here, you can considering the entry at 21,000, your stop loss would be initially set to 100 points below your entry points, which is 20,895. This basically acts as a safety net to limit losses if the market moves against your position. Now in the same fashion, let's consider how trailing stop loss works with the same framework. Let's say market moves up to 21,050 after you getting into the trade at 21,000 level. In line with the trailing stop loss strategy, you would then adjust your stop loss to a new level, maintaining the same percentage below the current market price. For example, if the market reaches to 21,050, you simply trail your stop loss 105 points below the 21,050, which is 20,945 level. So you will continue to do this as long as market is working in your favor. Now comes the second type of stop loss. Basically, this is my most favorite. In most of my strategies, I use this ATR based stop loss. Earlier, we have already discussed about the ATR we have already used it for defining the IB style. Basically, this method is particularly effective because it accounts for market volatility and it considers the changing market conditions along with the volatility changes. To calculate an ATR period stop loss, you can simply apply the average true range indicator within the specific trading time frame that you are trading in. Whether you are trading it 15 minute, 5 minute, doesn't matter. The active time frame you're working on, for that you have to apply the ATR. This is the first step. If you look at this example, suppose you enter trade at 20,000 level. Okay, this is an example. And at that moment, ATR, assume ATR is around 30 point. Then you multiply this ATR value by a factor. Okay, this factor again can be adjusted for particular instrument. In this case, assume I'm taking it as a 2. So 30 point ATR multiplied by multiplication factor, which is 2. So around 60 points is what the stop loss risk that you can carry in that particular trade according to the present volatility of the market. If it is a long trade, we subtract this number from our entry price, set our stop loss. Therefore, our stop loss would be at around 19,940 in this case. 20,000 minus 60, 19,940. And now let's say market moved in our favor. Let's say around 50 points market moved in your favor. We then recalculate our stop loss again using the same method. Again, I'm assuming ATR remaining at 30 points here. We subtract it from the current market price. So assume 20,050 minus 30.2, which is 60. So then our stop loss would be at somewhere around 19,090 points. The main advantage of this ATR based stop loss is the ability of its ability to adjust automatically according to the market volatility. When we do so, the chances of unnecessary stop loss triggering reduces a lot, which will help us to stick with the trade and ride the profits effectively. Let me share with you a real life examples here. A recent trade will illustrate that how ATR trailing stop loss works in practice. In this instance, we are looking at a long trade. As illustrated in the chart, you can see red line represents the trailing stop loss based on the ATR, calculated based on the ATR. As the market moved in our favor, you can see the trailing stop loss also shifted upwards, effectively securing our profits along the way. Now let's consider an example of a short trade in this scenario. As the market began to moving in our favor, the trailing stop loss adjusted accordingly. So this definitely illustrates the effectiveness of ATR based trailing stop loss method. I strongly recommend you should try this particular indicator to keep your stop loss. And again, I'm planning a separate video on how effectively we can use ATR. There are so many ways we can utilize this wonderful indicator. If you're interested, let me know in the comments. I will definitely try to cover those concepts in the upcoming video. Let's now discuss about the next exit strategy, which basically involves aggressive trailing. This is not an exit from the trade. It is an aggressive trailing of our stop loss as the market reaches to certain target levels. For example, a medium IB range, we often expect market to extend by approximately 1x of the IB. This we already understood when we were discussing about the day structure concept. When the market hits the target level as determined by our initial analysis, this is our cue, or basically this is the trigger to start aggressively trailing our stop loss. See, ultimately you could choose to exit the trade at this particular point, but I personally believe that more often beneficial to trail the stop loss instead of the exit, because we don't know how far market can move in that particular scenario. Here is an example. In a short trade scenario, the recent short trade scenario where the market moves in our favor and reaches to 1x of the IB extension target below the IB low, and we would then begin to aggressively adjust our stop loss in the downward direction. And the same principle applies to the trend days as well. When market extends IB by 2x in either the direction, we simply, if we are in the trade, we are going to aggressively trail it. Whether we are in a long or short position, this method helps us to secure profits while the market continues to move aggressively in our favor, because certain targets are already reached in our favor. So it make all sense for us to aggressively trail our stop loss and secure maximum profits in that trade. So that's where this particular exit method comes into play. Now it's time to test the strategies. Basically, I'm going to take you through the quick historical data verification to show how these strategies have performed in the past. For this, I'll be using the AmiBroker software. AmiBroker is definitely a powerful tool for coding and backtesting and even just seeing the chart. So this is a wonderful platform. I'm presently using this. Please let me know if you are interested to learn about it. You can let me know in the comments. I'll try to cover the detailed tutorial on it in the coming days. And also I'm planning to cover the algorithmic trading using the AmiBroker, focusing on how even beginners can automate their trades directly in the terminal using the AmiBroker. If you are interested, let me know in the comments. So this is the AmiBroker window, and if I just go to the analytical page of the AmiBroker, and here I've selected that formula, and let's click the backtest button. Once that is done, the results are in front of us. Again, for this analysis, I'm using 15-minute chart to examine our strategy performance over the 10 years data. So this is the report of backtesting. So as you can see, over more than 1,500 trading days, about 57.35% of the time we were right. That means strategy was working in our favor. Furthermore, the equity chart also shows that the strategy is effective in terms of the profits. That means when it is losing less points. When it is earning or when it is gaining, it is gaining more points. It clearly demonstrates that more often than not, our strategy has been profitable over the long term. Each year, in fact, every year it is profitable in terms of the performance. Well, that's all from me for this video. I know it was very brief, but my goal was to deliver the effective information in concise manner. But however, if there is anything that you found challenging or if you have a specific questions, please don't hesitate to mention them in the comments. Also, if there is a particular topic you would like me to cover in the future videos, I would love to hear about it from you. You can mention that in the comments. And most importantly, I have a request. If you like the video and if you found the value in today's video, please hit the like button, which it helps us to get motivated for better preparation for the next video. And please share this with those who are interested to learn about intraday trading. Once again, I wish you all the very best for your trading adventures. Thank you so much for watching the video. I look forward to seeing you in the next video. Until then, take care, goodbye, and Jai Hind.